We will now focus on the FTSE alternate investment market. Again, another growth market with small companies with the potential for accelerated growth, but naturally carry a high degree of risk due to the liquidity constraints. So, yeah, let's fire into it and see what we can learn. Okay, now moving on to the FTSE alternate investment market, it is classed as a sub-market to the London Stock Exchange, and it was launched back in '95. It's predominantly designed to cater for smaller, growing companies, providing them with the platform to raise the capital in order to expand their business. It is often considered more flexible and less regulated compared to the main market. But naturally, by being a smaller market is often riskier, as companies do not have to meet a lot of the stringent requirements for listing on the main market. So when we talk about the companies able to raise funds, they may use these funds for expansion, research, development, as well as any other activities that they may see fit. Now, one thing that is prominent with not only small companies but the AIM market in particular will be the volatility element. The AIM listed companies are relatively new, very inexperienced, still very much in their infancy. So they will be influenced by the news, earning reports, as well as market sentiment. Okay, and when we talk about market sentiment, this can contribute towards rapid and significant price movements in the AIM market. If there's positive sentiment, brilliant. If the stock is being talked up very heavily, you will naturally tend to see people buy on the back of the news. But if market sentiment is weak and there are rumors of whether it's board level issues or earnings not going to be as great as expected, you naturally tend to see certain degrees of sell-offs. And when we discuss risk, the risk factors are predominantly focused around liquidity. A lot of these companies will not have the amount of buyers and sellers the main market will. There's not a huge amount of shares in issue at a time, so you will get large gaps on the order book, which can make you more susceptible to massive price fluctuations, gapping, and not necessarily getting the price you want, not only for entry but also for the exit as well. Okay, now let's take a look at the individuals that will look to invest within the AIM market. They will come from various backgrounds, and they can be broadly categorized into different groups based on their investment objectives, their strategies, or their risk tolerance. Now, retail investors are a significant presence within the AIM market. There's no surprise there. These are everyday investors who will buy and sell stocks through brokerage firms or via a platform that they've signed up for. Retail investors are attracted to stocks based on the fact that they're looking for that accelerated growth. It's an opportunity to invest in smaller companies which are classed as perhaps more innovative at times. But as mentioned, they do take more of a long-term view, and they're not looking to get in and out of these companies on a day-to-day, week-to-week, month-to-month basis. So it's something that you will traditionally buy and hold. They are prepared for the fact that they can lose all the capital they invest. That's the natural risk associated with companies at its infancy stage. But again, it's also a massive diversification play, not only from risk but also looking at smaller companies within different sectors. Institutional investors such as investment funds, pension funds, insurance companies, they participate as well within the AIM market. These entities often have large capital pools, so they allow for their portfolios to have a significant amount of AIM companies within it. So you will have some portfolios which are dedicated purely to small cap companies. So don't be surprised, they are massive players. High net worth individuals, they naturally have substantial financial resources, and they may choose to invest in the AIM market purely to diversify their broader portfolio. Okay, it will never make up the bulk of what they do, but it will form a fraction of what they do for that potential of accelerated growth. And then finally, you do get the likes of, the family offices, the private equity, and the venture capitalists. Now, a lot of venture capitalist firms, they predominantly tend to invest in companies which are unquoted. Even though the venture capitalist firm is quoted on the AIM market, they normally tend to invest in unquoted companies, but they may take also positions within listed stocks which are fairly new, and they feel that they would benefit from further capital. Family offices are predominantly defined as it's like a fund manager or an investment arm managing the wealth of an individual family. Okay, and they will naturally diversify not based on risk but asset classes, different forms of securities as well. So these are the traditional investors that will be focusing on the AIM market. For yourself personally, especially when you are speaking to investors, they will more than likely have exposure in these areas. So it's important to be up to date and informative about the news or any rumblings that are going on within the AIM market and individual stocks, as it is a market that tends to do very well, especially in a bullish climate like we are experiencing right now. So always stay on top. Okay, brilliant. Let's go into the pros and the cons of the alternate investment market. A lot of the pros are very similar to the ones we've discussed previously, but let's always fire into them. The growth potential, many AIM listed companies are small and have significant growth potential. Investors who naturally identify successful companies early on may benefit from substantial capital appreciation moving forward, and that will naturally be one of your key selling points when you are speaking to investors. Second of all, a diversification tool. Investing in AIM can provide diversification benefits for the overall portfolio, and that's not just diversification across sectors, but it's also allowing investors to spread their overall risk rather than focusing on predominantly safe havens or the main market, which you may not see a accelerated return in certain sectors. You may want to shift an element of your portfolio within a smaller arena. Now, when it comes to M&A, mergers and acquisitions, a lot of the companies that are on the AIM market may become attractive targets for larger companies seeking to acquire, whether it's innovative technology or just to expand their market presence. So that's always one of the key tools for listing on the AIM. There is an exit plan by these companies to potentially be taken over. There are a number of tax breaks, stamp duty being the most prominent one, especially within the main market, 100, 250 small cap. You will have to pay stamp duty on any shares that you do acquire. This is physical ownership, so we're not talking about CFDs or options. We're talking about actual ownership of shares, which is 0.5% when you do purchase shares. You won't have to pay that when it comes to AIM listed companies. When we talk about a startup company, these companies naturally have just started in their venture or their route to where they want to be, and the growth potential is naturally aligned with that. When we talk about a lot of the cons, that they are going to be pretty prominent. When we look at the volatility, there's no two ways of avoiding it really. A lot of these companies will have very little liquidity. So if you have little liquidity, the stocks tend to be more volatile, especially if you see mass selling or mass buying as well. You may get out of a stock too early when you should have held it that bit longer. So there's not enough buyers and sellers at times, purely based on the fact that the companies may not also have enough shares that they want to issue to the public. Okay, there is a chance of potential delisting if a company faces financial challenges or other issues that could lead to delisting. This can result in losses for the investors, especially if they're not able to sell their shares before the company is delisted. There is always the risk of limited news. There's not a huge amount of news out there for a lot of companies, so you would have to do a hell of a lot of research, and even if the news is released, it is few and far between. So always keep very much up to date, but limited news is not always a great sign, as investors could lose patience and start selling stock. Business failure goes hand in hand with potential delisting, especially on a managerial standpoint. If managers or MDs decide to leave the company, it could send shivers throughout the rest of the organization, and natural business failure could lead to delisting and loss of partial or all of your capital.